Good morning, everyone. Well, the story is getting quite familiar. U.S. indicators disappoint, and the dollar moves a little lower. The key point, perhaps, was in equity markets, not FX markets overnight. Equities shrugged off yesterday's weakness in Asia, and both European and U.S. equities closed higher. This encouraged risk-taking sentiment, and the Aussie and the Kiwi were the big winners on the day. While, on the other hand, the safe havens yen and Swiss franc eased. Eurodollar just remained within its recent range as the European news dampened expectations about further ECB easing next week. Although Eurozone CPI had the largest fall on record on a month-on-month basis in January, the year-on-year rate was actually revised a little bit higher. All three IFO indices beat the market forecast, and Belgian business sentiment improved. So that diminishes the pressure, takes a bit of the pressure off the ECB to ease further at its meeting next week. So the next signpost for the ECB is going to be the preliminary inflation data for February, which is coming out later this week. The market's forecasting a further slowdown in Eurozone inflation. That it would be the fifth print below 1% in a row. So that could rekindle the fall, and inflation could rekindle the deflation fears and push Eurodollar lower. Personally, I think these deflation fears are quite justified. Yesterday's data showed that non-energy industrial goods fell 3.9% month-on-month in January. Of course, that's on a not seasonally adjusted basis. The main question for next week, though, is probably what the ECB's economists will forecast for 2016. Even if the data do show the EU edging further towards deflation now, if the economists forecast higher prices in the future, then I think the ECB is likely to wait a bit longer. After all, EC President Draghi said the ECB would ease policy, quote, when we have reason to think that our medium-term assessment for inflation is changing for the worse, unquote. Notice that he said our medium-term assessment, not when inflation was actually changing for the worse. Natural gas had a wild day yesterday, with the March contract initially rising about 4% and then later collapsing around 15% after the U.S. National Weather Service predicted warmer weather. An end to the unusually cold weather in the U.S. could also signal an end to the depressed U.S. economic statistics, and that'd be a big help to the dollar, I think. Today, we've only got second-tier data from the Eurozone. The final data on Germany's fourth quarter GDP, Italy's retail sales for December, and its consumer confidence for February. None of these is likely to be particularly market affecting. In the UK, the BBA mortgage approvals for January are forecast to rise. That could help to support the pound. From the US, housing prices or measures of housing prices are forecast to be mixed, while the Conference Board Consumer Confidence Index and the Richmond Fed Manufacturing Survey are expected to be lower. Those sorts of figures could prove dollar negative as yet another in the string of disappointing U.S. data. For more information, including technical analysis, please read our full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.